Welcome to the daily update. This is being prepared Friday, June 17th, where we'll look at the action in the market today and then see how things look for Tuesday, June 21st. And please be reminded that the markets are closed on Monday, so we have a 3-day weekend. Also, you'll probably notice that this video is a little bit different than the other videos that I've been posting, in that I have a hardware issue with my other computer, so I'm having to go back to the old school way of doing videos. And those of you that first started watching my videos, this is the same way I was doing them a few months ago. So I apologize. This will all be take one. If I make mistakes, flub up my words, what have you, I don't really have the ability to go back and take that stuff out. I just kind of have to plow through. So please bear with me. Before we get started in the video, I just want to make a few announcements. I am opening my program for memberships, and I'll be preparing a video over the weekend that will talk to you more about what's involved in the program, when it will be available, and just some ideas that I have for that. Also, please double check your YouTube subscription. YouTube has gone through on my request and flushed out a lot of the bogus subscriptions that were in there, and sometimes they take out legitimate ones. So please double check that. Also, I'm going to start using the spxinvestingblog.com more so that I'm able to communicate with you. For example, there are some days when I can't make a video, or I'm going to be late, or something is happening. I don't have any way to really let you know that because I try to post a video every day. Well, if you go to spxinvestingblog.com, I will be starting to put messages there. Then, as I said earlier, the markets will be closed on Monday. There'll be no daily video this upcoming Friday. I have some other commitments that just don't allow me to make a video that day. And then for right now, the technical overview part of the video, I'm taking that out because nothing's changing right now. So when things do start to change, I'll be able to bring that back. But I just see that as wasted time right now. So let's go back and talk about what happened on Friday. It looked like we were going to have a rip-roaring up day. The futures were pretty positive. It looked like we were going to have a big gap up. Well, as we got closer to the open, the futures came down to earth, more or less, and we ended up just having a small gap higher, and we weren't even able to get to R1. I think a lot of people were really exhausted. It was also quadruple witching on Friday, so you had a lot of different strike prices in play, a lot of volume having to do with shoring up option positions and those types of things, and we ended up not seeing that big of a day. Once after we opened, prices did fall back negative, and we pretty much spent the day going sideways. We went a little bit positive, a little bit negative, but we just kind of hung around the unchanged level for most of the day. By the time we closed, we were up 0.22%, less than 0.25%. And I say the volume was way above average, and that was because of quadruple witching. The technicals right now are still very negative, and we're getting more and more oversold. And there are some potential positive things that could be developing, that if we were going to bounce, not necessarily in the next session or two, but we could be getting close to that. And I'll go through that and show you some charts. Everybody is all fixated on inflation and interest rates, which is producing growth concerns. And that story has been the same now for weeks, and it will probably continue to be the story. But we also have a lot of geopolitical concerns, and any one of those can come to the forefront at any time. And then earnings as they are released by each company. What are some things that we can say? Not a lot, other than what I mentioned, that it was quadruple witching. We're really extreme as far as fear. And another thing that was kind of interesting is that all the different energy areas, energy itself was down, but oil, gas, natural gas, they were all down for the day. And we've been hearing about other countries raising their interest rates because they're really worried about inflation. They did it in Australia, Brazil, Europe had some meetings over the past week. Well, Japan's not doing that. And that's part of that longer term scenario that I'm talking about. We're seeing problems in Japan that we're not necessarily seeing in other countries. They ended up deciding that their rate should be the same at 0.01 negative. So they actually have negative interest rates in Japan and have had that for quite a while. Interest rates overall on Friday fell, and some of the yield curves are either flat, which means they're even with each other, or they're starting to become inverted. And then there's a lot of recession concerns right now. The economic reports that came out, we had industrial production. It increased 0.2% month over month. They expected it to be up 0.5%. So that's less as far as production. Capacity utilization, it increased to 79, where they expected it to be at 79.3. So a little bit weaker than expected. And then we also had the leading economic index, or LEI. It was down. Now, the idea behind this indicator or this index, is it's supposed to tell us what's going to happen in the future, but the markets don't really pay attention to it all that much because so much of it is known before they even put this out. And it doesn't really end up helping us all that much, but it was actually down 0.4%. Our trend continues to be negative, and it's a strong trend right now. It's getting stronger every day. The bias continues to be negative. Even though we had the up day on Friday, I'm still keeping the bias as negative because it's still a real negative environment. And momentum, the last 2, 3, 4, 5 days have also been negative as well. Let's go back and talk about the day's session. We are at extreme fear. We had a reading of 13 yesterday. Well, we have a reading of 14 today. It really didn't change all that much. And this shows you where we've been historically. So now we're down into this extreme area. You've got a lot of people that are really concerned right now. One thing to point out is optimism. And I found this at IsabelNet. We're really seeing optimism falling right now. And we can see there's other times in March of 2020. That's when the whole COVID thing hit. People weren't very happy then. In early 2019, that was right after we had the meltdown, the Christmas Eve meltdown in 2018. People weren't real happy at that time. Then you see 06 and 08, we were having some financial difficulties at that time. And of course, the year 2000, and then back into 1998, there were some real problems, especially in Asia. Well, that was after the Asian currency crisis, but this just shows that people aren't very optimistic right now. That kind of goes hand in hand with our extreme fear that we're reading right now. We did see some inflows over the last week into equity funds. So people are still putting money into the market, and it is positive instead of taking money out of the markets. This just is a kind of a historical chart where this red line just shows you the S&P, and these are just different events that have happened. And I wanted to include this because you might find this interesting. Along the bottom just shows the Fed funds rate and then the 2-year rate, which we've been watching very closely lately, and just different things that have happened going back into the mid 70s, and just what the Fed did during that time, how the market acted during that time. And I thought you might find that interesting to look at. Then when they ask people, what do you think is going to happen over the next 12 months? Well, they think that high quality stocks will beat low quality earnings, or high quality earnings will beat low quality earnings. So that means the more established companies, instead of these fly by night new companies that people always want to get behind when it becomes the craze. They also think that value will beat growth. And that's what we've been seeing in 2022, where a year ago, it was growth that was beating value. People are now more focused on high dividends because they're not seeing a lot of capital gains with their stocks going up. So they're hoping to get some kind of income through dividends. They think that small caps might slightly outperform large caps. That's sometimes where you can find the growth. They think that low volatility stocks will end up beating high volatility stocks. And then high grade bonds will beat the high yield bonds, which we often call junk bonds, and high momentum will beat low momentum. Not a lot of people think that. They see us going down, and high momentum stocks, yeah, they're great when the market's going up, but they can be pretty negative when the market's going down. Just to go back and look at our equity put call ratio over the last 5 days, it declined a little bit. And I have another chart later on, and I've switched that up in the order. I think you might find that kind of interesting. The VIX declined a little bit on a closing basis, and our bar was underneath where we had been. So this could still spike up higher. This means that fear would really increase, but it's not really spiking up yet. The VIX of the VIX also showed a real slowdown on Friday. The Ulcer index continues to advance. This is another measure of fear. As this is going up, that means people are getting more and more concerned about things. We also had the Ridex bear bull ratio, which went up slightly, but not necessarily extreme. So even though people are freaked out right now, they're really fearful, they're not really fearful right now. We need to see some kind of capitulation to really make some kind of a bottom in the market. If we just keep traipsing along sideways the way we've been doing as far as sentiment, even though we're fearful, we need to see some kind of a blowout if we're going to see the market really bounce and start to head higher. And we're not necessarily seeing that yet. So work with me on this, because there's a scenario that I'm kind of going with. The individual investor survey that comes out every week shows that individual investors are very pessimistic right now, which could be positive. We're down 23.39% from the all-time high. Some different support and resistance. Here's the intraday chart to give you all the different levels for Tuesday that you might find interesting. And then here's the daily chart, which we're still above S2. If we start to go up, we will have resistance probably at S1 at about 38.59 or so. But you can see the real increase in volume on Friday because of the options expiration. Here's this machine gun chart, which shows that we broke down below support. Once we break through support, if we start going back up, that will then become resistance. But we're still above support, and we haven't really gone back to deal with resistance yet. Here's some other points on the chart. These are good for the whole month of June. And again, you may want to stop this and look at some of these levels. The numbers are up here in the left-hand corner to kind of give you some different support and resistance areas. Fibonacci retracement, we've broken down below the low that was set earlier in 2021. This will now become shorter term resistance. If we start going up, we're going to have to break through this first. And that means we have to get back above 3,700. This chart also shows how we've broken down below this support. The next level of support is around 35.14. If we start going back up, there's more resistance at about the 38.29 level to down to 38.26 or so as far as resistance. This kind of shows the same thing, but I've tried to take some of those other lows off of here, just showing possible support if we go down or resistance if we start going up. We have broken below on the weekly chart, and this is one of the positive things, and this could potentially be a positive setup. This was brought to my attention by one of the people that watch the videos, where this is a weekly chart of the S&P, and we're coming down to the 50% retracement from the COVID low to the all-time high. Well, we're also seeing the 200-week moving average right at about that same level. If we have some kind of capitulation, this is just a scenario that I'm throwing out there, where we really start heading lower and we go down to this level, we'll want to watch this 35.02 to 35.09 or so. If we can stay above that, that might give us some kind of a bounce. And again, there's a possible positive scenario that I'm going to share with you later on. And I probably should have included this chart in that spot. Then looking also how we've broken below this Fibonacci level, going back to the COVID low to the all-time high. It's a little cleaner chart here. The sectors, we're kind of across the board, half and half. Communication and discretionary were up over 1%. The ones that were down weren't down all that much, except for energy. It was down almost 5.5%. And this shows you that energy is still in the lead, although we're really seeing this start to come down. All of the other sectors remain negative since the all-time high. Our technical alerts, most of them were negative. The S&P was able to get above 3,700, but then later in the day, the S&P set a 52-week low. And you have a lot of the other indexes that are setting 52-week lows. The oil dropped down below 115 and then eventually actually fell below 110 as well. Intraday, in the overnight session, it was looking pretty positive. We were up over 1%. It's like, here we go. Everything's looking good. Well, right before the open, we fell down. There was a bit of a spike. This spike up, that's the open on Friday. But a lot of the overnight gains they evaporated before the open happened. So we ended up gapping up just a little bit. We couldn't even make it up to R1 on Friday. We ended up coming back down. We didn't go all the way down to S1 either. We just kind of bounced along the unchanged line for most of the day. We spiked up a little bit, but then came right back down. So it was really not all that eventful as far as days in the market go. We are in a negative trend. The ADX is advancing and the red line's on top, even though it has come down over the last couple of sessions. As far as breadth, this is another area that I want to bring up again, that this is the S&P. This is showing that we're getting extreme negative with those stocks that are below their 50-period moving average, that are above their 50-period moving average. And other times when this has happened, that has marked some kind of a low in the market. What I'm going to show you later is we're seeing the same thing with small caps and mid caps. So we're seeing kind of a convergence there. And I'll show you that chart here in a moment. But overall, we're really breaking down as far as breadth is concerned, both based on price and volume. Our advanced decline ratio is starting to get extreme negative. The new highs and new lows are also really declining. Accumulation distribution is also showing weakness. And these are stocks above their 200-day simple moving average. And we haven't quite gotten extreme. This is one thing that I'm just kind of role playing out, or just a possible scenario. What if we do really head lower? What if we get down to that area of major support? If we do that, we might get to an extreme reading on this chart, and that could set up a pretty sizable bounce at that point. I'm not saying that's what's going to happen. These are just different scenarios that I'm constantly running through at any given time, because we're certainly not positive now. Let's look at some short-term charts. We are extreme negative with the 20, 50, and 200 exponential moving average, but we still have room to go lower with the 200. Stochastics, extreme in the short, intermediate term, and getting extreme in the long term. The rate of change is still extreme negative, even though it bounced up a bit. McClellan oscillator also bounced a bit, but it's still extreme negative. The force index bounced a bit, but still extreme negative. Stochastic RSI, extreme negative, as is the Williams percent R. Intermediate term, the balance of power. Haven't shown this chart in a while. We're starting to get extreme negative again. The rate of change going back 10 periods bounced a little bit, but still extreme negative. This is the TTM squeeze. I forgot to put the label on this one, where we are negative and not necessarily extreme on this chart. Sean trend meter, extreme negative. Standard deviation, we're way far away from the mean price. The PMO study, we are extreme negative with those percent of stocks inside the S&P that have the PMOs rising. No, we have very few of those right now. The buy signals are also extreme negative, and those that are above zero are also getting extreme. All of our oscillators have now switched over to negative. The BPI is also giving us a really strong extreme negative reading. That's why I would really resist the temptation to try to jump in for a bounce unless you're an ultra short-term trader at that point. We don't want to go against the trend in this kind of a market. Just about the time we think we're going to get a bit of a bounce, you get whipsawed, and suddenly what you thought would be a short gain ends up being a quick loss instead. So that's my personal recommendation. That's what I do personally. The CCI 14 periods is still extreme negative, but improving, as is the 20 period CCI. The Chaikin oscillator is trying to turn up a little bit, and sometimes this can help be a little bit of a leading indicator. Sometimes it just fools us, but we want to keep an eye on this. Chaikin money flow also trying to get back a little bit more positive now. The ease of movement is declining on 14 periods, where we're getting back more to neutral when I just go back one period. The money flow index is declining and below 50. Volume really spiked up with expiration on Friday, and we've been seeing a real increase in volume overall lately. The ultimate oscillator, extreme negative and trying to bounce up. The vortex is still negative because the red line's on top and the green line is on bottom. Summation index declining based on price and volume. Rate of change going back 50 periods, trying to turn up a little bit, but still extreme negative. The Swinland the Swinland trading oscillator is trying to bounce up. And this is another one that sometimes can be a little bit of a leading indicator for us, where it will sometimes turn up before price gets ready to turn up. But other times it's given us false signals too. The boom indicator shows we are really extreme when we measure the distance between price and the 50 period moving average. We're getting to an extreme point with the 200. And again, if we do see a drop down to that support level, this is likely to go down to extreme negative too. And then we would see more of a convergence at that point. The RSI 14 period is negative and not extreme, where the 9 period is more extreme, negative. Our different charts, the Heikin Ashi is negative. The Kegi is also negative with the red lines. We don't have anything new with the point and figure chart, but this is looking more negative overall. We see lots of zeros here. 3-line break is also quite negative right now. The Renko is solid red boxes, so that is negative. Our different trading systems, the Elders RSI, the Elders Impulse system is negative for the S&P, and it's also negative for the SPY. The SAR is negative because the dots are on top, and our go no-go system is deep purple still. Long-term charts, we're really extreme with the 50, 150, and we're getting more extreme with the 200 simple moving averages. The rate of change going back 200 periods, we're getting back down to the COVID low. See, so we're kind of seeing what could be some real support that's being confirmed on many different charts, but we still have to follow a little bit further for that to happen, and we need to see sentiment freak out at that level, or get to freak out. Our special K is still negative. That's our long-term trend. When we look at the broad market, the Amex, the NASDAQ, and the NYSE, and we take a 5-period moving average of the highs and lows, we're starting to get extreme. Now, we could still go further than this, but we are in extreme negative territory. Looking at the broad market, this is what I wanted to show you. The small caps, we're also getting an extreme reading with those stocks that are above their 50-period exponential moving average. We saw that in the S&P. Here, we also see this in the mid caps. So we're seeing some across the board signals right now. The diamonds are negative. The Qs are back to neutral. Believe it or not, the NASDAQ was actually up on Friday. So we're back to a neutral reading there. The dollar is kind of just bouncing all over. It really spiked up, then it came down. Well, it was up over 1% on Friday. And here's the weekly chart, just showing we haven't quite made it back to that previous weekly high but the dollar's been holding up fairly well lately. And this just talks about US valuation and the trade weighted index, where along the bottom, this lighter colored blue, these are the percent that are saying that the dollar's overvalued. Okay. And that's really starting to go up. A lot of people are saying, wait a minute, the dollar shouldn't be going up, it should be going down. Well, when you compare it to the Japanese yen and the euro and other major currencies, right now, the dollar is like the least crappiest currency out there because they're all fiat currencies. None of them are backed by anything. They're not backed by gold. There's just the faith and credit of the US government. Well, since we're running into difficult times, the dollar, it'll probably tank somewhere in the future, but right now it's still been holding up. And just to measure our correlation between the S&P, which has been going down, and the dollar, they still have a fairly strong inverse relationship. One of the things that really made me wonder, okay, are stocks really going to go up on Friday? We saw the futures were up strong, but we saw the dollar was up too. So that made me real suspicious that any kind of a meaningful bounce was going to happen. When we see the dollar going down and stocks going up, that gives it more credence. But if we see them going in the same direction, at least over the last few trading sessions, something's going to give at that point. And lately it's been stocks. Here's the euro and the dollar. They're just about even again. And then here's the Japanese yen on top. These are the three major currencies in the world, and it's been showing some real weakness. Here's the euro, which has been declining, and the dollar, which has been holding up. Oil, it was down big time. It declined all the way down to 107.99 on Friday. So maybe you'll feel a little bit of relief at the pump, but it's still quite high. And the correlation, we're seeing that kind of go away, where stocks have been kind of down lately. Well, with oil declining, we're seeing that inverse relationship not as strong as it was a couple of days ago. Gold is slightly below the moving average on the ETF and the 200-day moving average. And silver's been having trouble too. We've had a recent death cross, and we were down over 1% on Friday. Bonds were up slightly, virtually unchanged with the overall bond ETF, where we saw a little bit of a decline on the world bond index. And we're getting back to this COVID low. So again, something could be setting up. If we see bond prices start to go up, that means that interest rates will go down. And if we see bonds and stocks move in tandem for a while, that could really help out stocks, which would bring down interest rates. 10-year yield, after breaking above this Fibonacci level, it's 100% retracement. We're coming back down now on the 10-year. And this is the resistance that we had been dealing with. This chart and this chart are the same. They just show things a little bit differently. Where we broke above, well, now we're coming back down below this resistance. And we're still seeing a pretty strong correlation between interest rates going up and stocks going down. Well, if we see stocks really go up and interest rates go down, that could produce a more healthier environment, more healthier. That's good. Corporate bonds also bounced up a little bit on Friday. The 30-year yield broke above the 50% retracement, but came back down overall. And we can see they're all bunched up here. This just means things aren't really normal. This is like the flattening of the yield curve here. But we spiked up a little bit with the 2-year, but all the others, the 5, 10, and 30, they're all jumbled up closer together. And the tech sector, as it's been going down, and the 10-year yield, as it's been going up overall, well, both declined on Friday. So we saw a little bit of a turn up with our inverse correlation measurement. And then the 2 to the 10, it's hanging in there for right now, but it's really close to going inverted. The 10 to the 3-month is okay. The 30 to the 5, it's gone inverted again. The 10 to the 5 is also inverted. And the 10-year to the Fed funds rate continues to be okay right now. So we're seeing some weird things in the different yield curves right now. Okay, our possible positive scenarios. I brought this up in yesterday's video, but as I was looking at this, I'm going, wait a minute. We don't get these readings very often where we get a 0.8 reading or higher. Well, we're breaking above that now. That could, and this is of the VIX. So this is the 5-period moving average of the VIX. And when it gets to a really spiky level like this, that often marks a bottom in the market. Now, sometimes it can spike more than once. So just because we went up here doesn't mean we're just going to start shooting higher right away. But this could be part of a bigger picture possible positive scenario. This is another thing brought up in one of the videos that I was watching, where we've been making lower lows with the S&P, but when you compare the QQQs with the SPY, we're seeing a bullish divergence. With discretionary in the SPY, bullish divergence, large cap against growth against value, a bullish divergence. Okay, a lot of times we'll see that at market lows. When we compare growth and value with large caps, positive divergence, mid caps, positive divergence, small caps, positive divergence. So what I did, I just showed you this chart in yesterday's video. I'm actually putting this in the possible positive scenario cycle or area, because some of our other ones aren't working out yet. This is just something that we can keep an eye on and go, okay, we're possibly at support. We're seeing some positive divergence here. Maybe if the market can freak out a little bit more to scare people out of it, maybe that can help turn things around and we'll have a more meaningful bounce. The small cap index was actually up a little bit. And the reason why we're looking at that is we're keeping an eye on the ratio, and we saw a real breakdown. So in our other possible positive scenario, we can pretty much take this off the table right now. Oftentimes we'll see a spike up in small caps before we see a spike up in the S&P. That's not happening right now. The correlation between the S&P and the 2-year, it's still strongly inverse related. So as the 2-year goes up, the S&P has been going down. If we start to see the 2-year come down, we might see the S&P have a chance of going higher. And then we're looking at the treasury spike here. Well, this is not a spike, and it might be a little hard to see, but when we really spiked up in the 2-year, that blew out the spike that we had been watching. The staples sector, this is another one of our possible positive scenarios. Well, the staples have been really having some trouble. So we're seeing a bit of a breakdown with our spike right now, which could be okay, but we're still going off of this major spike that we saw before in the ratio, but we're not seeing a follow through in price yet. So could this spike up even higher and give us a more valid signal? That's what I'm watching for. So what's our outlook for Tuesday? We are negative and oversold as far as the technicals are concerned. There are some possible positive setups. It doesn't mean they're going to happen on Tuesday. It doesn't mean that they're going to happen right away. These are just things that we want to be watching for. And that's why I do these videos every day, to try to point these things out to you. We also have sentiment is extreme negative, but we were camped there for a long time and it didn't produce the climactic critical mass type of reading that we're really looking for. The only real economic report coming out on Tuesday is existing home sales, and then all the different geopolitical events which could come to the forefront at any time. Russia, Ukraine, and the supply chain issues, because there's still parts of China that are being locked down and tested again. Inflation and interest rates, that's what everybody in the US is really concerned about. If we continue to fall, there may be a risk of margin calls, and that could kind of feed into more selling because people have to get rid of their stocks if they're using borrowed money. Oil, well, it came down quite a bit, but what if it spikes up again? Or what if it continues to drop? That might add some support to stocks. If it goes up, that may produce some headwinds. Earnings as they come out, we're following what the Fed may say, whether it's an interview or a speech or something, and then the longer term situation in Japan. So our different scenarios, and you notice it's not scrolling this time. I can't do it when I record the videos this way. we are still down overall because of all the things that I just talked about right here. So we still have some more room to fall. Just because we're oversold doesn't mean that we can't go further. Just because we're getting close to support, we might still need to fall down to that support. So that still bodes well for the negative scenario. What could help us go up? Well, we are oversold. You've got a lot of pessimism right now about the stock market and some of these possible positive setups that may work themselves out over the next session or two. The staple spike, we don't really know. It looks like we're breaking down with that, and we're not seeing a follow through with price. The technicals, well, we're so oversold, so we have to look at different pivot levels, whether they're intraday or daily pivots. We try to get back up to the short-term moving averages. We're not even there yet. Some possible fib retracements, that might act as support, but if we start to go higher, that could act as resistance. And then different previous levels, higher lows set earlier, that may act as either support or resistance. And we're not neutral right now. And notice that I run all three of these scenarios at the same time. And that's what I do as part of my program. Just because we're going down, I'm saying, okay, what can make the market go up? What can make the market go sideways? And then out of all three of these scenarios, what's happening right now? But we're always keeping an eye on the other two scenarios just in case things do change. So our conclusion then is the S&P is negative, short-term, negative and oversold, but it could get oversolder. I just love that. Intermediate term, the same thing. And long-term, as long as we're below that 200-day moving average, we will remain negative. So thank you. Have a very good weekend. And I will prepare the intermarket analysis video as well as the weekly video. For the time being, they will be prepared this way. So please excuse my fumbles and slips and messed up words and mistakes that I make. I still hope that you find this video useful. And yes, I talk a little extra at the end because of the end cards on YouTube. I don't want it to cover some of the things that I've been talking about.